If you passed away tonight, your family would not be able to get to a single dollar sitting in your bank account. Not tomorrow, not next week. A will wouldn't fix that. A notary stamp wouldn't fix that. Even a full estate plan drawn up by a lawyer wouldn't fix that. But there's one free form, just one, that skips around this whole mess. And almost nobody knows it exists, for a pretty simple reason. The people whose paychecks depend on the current system have zero reason to bring it up. I'm David Reynolds. My job is representing everyday taxpayers face to face with the IRS. I sit down across from IRS agents and bank compliance officers on behalf of regular people, week after week. If this is the kind of thing that helps you, go ahead and subscribe, because I put out breakdowns like this every week to protect your money and your family, explained in a way that actually makes sense. The number one financial disaster I see over and over isn't a bad stock pick or a tax slip-up. It's a family standing at the bank counter days after a funeral, being told they can't touch money that's rightfully theirs, all because one form never got filled out. That form takes 10 minutes. It doesn't cost a dime. You don't need a lawyer for it. And nobody's going to mention it to you unless someone like me does. Here's the legal backbone that still runs the show with your money. Back in 1969, a group called the National Conference of Commissioners on Uniform State Laws finished writing something called the Uniform Probate Code. Most Americans have no idea this thing shaped how their money works after they die. It set up bank and credit union accounts as contracts, legally separate from anything written in your will. Over the following decades, states one by one signed on to this framework, and today every single state runs on some version of it. Courts have backed it up again and again since then. In plain English, here's what that means. The agreement between you and your bank, not your will, not your trust, not your estate plan, decides what happens to your cash the moment you're gone. A beneficiary you named on a simple bank form beats out a will that's notarized, witnessed, and written by a top attorney. Every single time, no exceptions. Your will still handles your car, your furniture, your jewelry, the stuff sitting in your house. But your cash? That's governed by whatever contract you signed with the bank. If you never named a beneficiary on that account, the money doesn't go to your family. It goes to your estate. And the second it lands in your estate, probate kicks in automatically. Probate is basically your local court stepping in to check your will is legit and then handing out your stuff under a judge's watch. Most states start requiring probate once an account hits somewhere between $50,000 and $100,000. For a lot of retirees, that's an easy line to cross. Once that happens, your family is stuck waiting. The court works on its own timeline, not yours, not theirs. Here's the part almost nobody understands about probate. It's not quick paperwork. Nearly every state builds in a waiting period, usually 3 to 6 months, just so any creditors can step forward. Doctors' offices, credit card companies, anyone who thinks they're owed money gets that window to make a claim before your family sees a cent. It doesn't matter how tidy your finances were. Meanwhile, life doesn't pause. The funeral home still needs paying. Grief doesn't come with a break from bills. That brings us to Dorothy's story and a warning. She did everything by the book, and it still fell apart. Dorothy was 71, a retired teacher living in Illinois. She sold her house and walked into her bank with $350,000 from the sale. She opened a regular savings account, paid an estate lawyer $800, and had him draw up a solid will, witnessed, notarized, and clearly splitting everything between her 2 grown kids, Michael and Sarah. She tucked that will into a lockbox under her bed and told Michael not to worry, everything was handled. It wasn't. Dorothy had a stroke and passed away. Her kids flew in, got hit with an $11,500 funeral bill, and Michael brought the death certificate and the notarized will straight to the bank. The branch manager glanced at the account, glanced at the will, and pushed both back across the counter. Dorothy had never filled out a payable-on-death form. The account only had her name on it. Because the balance was above the state's cutoff for small estates, the bank legally couldn't hand over a single dollar. A will is really just a set of instructions written for a probate judge. It means nothing standing at a bank window. The bank only answers to whatever's written in its own contract, and that contract didn't list a beneficiary. So the account froze solid. Michael and Sarah left the bank empty-handed. They put that $11,500 funeral bill on their personal credit cards, paying interest north of 20%, while $350,000 of their mother's money sat just a few feet away, completely out of reach. Then probate began. Opening the estate with the court cost $389. Illinois law required them to run a public notice in the local paper for 3 straight weeks to alert any unknown creditors. That ran $250. The bond for the executor cost another $1,000, and that was just the starting cost. The probate lawyer charged a percentage of the whole estate, which is pretty standard, and on an estate this size that came out to more than $10,500. That mandatory waiting period for creditors dragged the case out for months. All told, the family waited 14 months before they could touch their mother's savings. They lost over $12,000 to fees alone, on top of the interest still piling up on that credit card from the funeral. Dorothy didn't make a mistake. She had the will, the notary, the lawyer. None of it mattered once it hit a bank contract. What happened to her wasn't some rare fluke. It's exactly what this system is built to do. And there are 3 specific ways people wind up trapped in it. Before I go through those 3 traps, pull up your online banking right now or grab your latest bank statement. Look for a beneficiary section. If you can't find one or it's sitting empty, that already tells you something. Write down what you see because it'll tell you exactly which trap you're standing in. 3 ways people lock up their own money without realizing it. The first trap: there's no beneficiary listed at all. This is the situation I run into most. You opened the account years, maybe decades ago. Nobody at the bank ever brought up naming a beneficiary. You signed the card and walked out, figuring your will would take care of it later. It won't. Under the legal framework now written into state law nationwide, your will has no power over a bank account. That account falls straight into your estate, and probate opens up automatically. For someone with a smaller income, this can be brutal. A 6-month probate process on a $60,000 account can eat up a big chunk of it in fees and court costs before the family ever sees a dime. For middle-class retirees, the usual assumption is that the estate lawyer already took care of this, but most estate lawyers only write wills. They don't file bank beneficiary paperwork. Those are 2 completely separate documents handled by 2 completely separate places, and almost nobody explains that when you're writing the check for your estate plan. The second trap: an old, outdated beneficiary form. This one's actually more dangerous than having none at all because it fools you into thinking you're covered. Maybe you named someone 20 years back, an ex-spouse, a parent who's since passed, a sibling you're not even close with anymore. That name is still sitting on file, and that's who the bank pays out to. Doesn't matter what your current will says. The Uniform Probate Code, wherever states have adopted it, is crystal clear on this. Whatever's on file at the bank wins, full stop. Courts have ruled against spouses, adult kids, and estate executors again and again, even when they were certain a newer will should override an old bank form. It doesn't. The bank checks the form in its files, not whatever's sitting in your lockbox. The third trap: assuming joint ownership covers you. A lot of married couples assume that just because they're married, everything automatically passes to whoever survives. In plenty of states, that's flat out wrong. Joint tenancy with survivorship rights is a specific legal setup that has to be created and documented at the bank on purpose. Being married doesn't create it by itself. What actually decides the outcome is how the account is titled and how your particular state treats property between spouses, not your marriage license. And there's a hidden danger inside the most common fix people try. Lots of older folks add an adult child directly onto their account as a joint owner, hoping it'll make it easier for that child to pay bills if something goes wrong. The idea is good. The legal fallout can be ugly. The instant you add someone else as a joint owner, most states treat that money as partly theirs, right now, while you're still alive. If your child gets sued after a car accident, that money can be pursued in the lawsuit. If your child goes through a divorce, their spouse could walk away with part of your savings. If your child owes back taxes, the IRS can go after your account to collect. Adding a joint owner hands over your exposure to every debt and lawsuit risk that person carries, immediately and fully. The payable-on-death setup sidesteps all of that. It gives your beneficiaries 0 rights to the money while you're alive. Your savings stay completely yours, fully shielded from their creditors, right up until you pass. Then the handoff happens cleanly, through the contract, with no court ever getting involved. All 3 of these traps share the exact same fix. One form, free, sitting at your bank right now. So here's what I want you to do next. There are exemptions, tax breaks, and refunds most seniors already qualify for but never claim. I've gathered every one of them in a single place, state by state, form by form, so you're not stuck digging through government websites for hours. It's all laid out simply and quickly, so anyone can find what applies to them. No matter which state you live in, there's money you're leaving unclaimed. It's called the Senior Exemption Playbook, and it's pinned in the very first comment under this video. Just tap it once and you've got everything. Now stick around because the last part covers the one form that makes this entire problem disappear. and it's the whole reason I made this video. The form that makes probate pointless is called a payable-on-death designation, or POD for short. This idea actually goes back to a 1904 New York court case called Matter of Totten, which decided money could pass directly to someone else after death without needing a formal trust or a court's involvement. That idea eventually got written into the Uniform Probate Code, Section 6-101, and some version of it now exists in all 50 states. It's not a will, it's not a trust, it's simply an instruction to your bank, running on the exact same contract-based track that froze up Dorothy's money. And because it runs on that same track, it skips probate entirely. The bank doesn't check with the probate court, it just looks at whatever designation is on file. Once a valid POD is on record, your named beneficiary shows up with a certified death certificate. The bank verifies it, processes the transfer, and that's it. No judge, no lawyer, no filing fees, and no months-long wait. How fast it moves depends on the bank. Smaller banks might process it that same day or the next business day. Bigger banks usually take about 3 to 5 business days. What it definitely doesn't take is 14 months. Filing a POD form costs absolutely nothing. Every bank insured by the FDIC has to offer it, and every insured credit union offers something equivalent. There's no fee to set it up and no yearly fee to keep it active. It costs nothing because the bank makes nothing off it. It exists purely to protect you and whoever you choose to name. Now here's where most people stop too early and where the gaps usually show up. A POD form covers your regular bank accounts, checking, savings, money market. It doesn't automatically stretch to cover every account you own, even at that same bank. A certificate of deposit needs its own separate form. If you filed a POD for your checking account, that doesn't do anything for a CD sitting at the very same branch. Every account is its own legal contract, so every account needs its own beneficiary form filed. If you've got 3 CDs at one bank, each one needs a POD filed on it individually. Brokerage accounts use a completely different form called a transfer-on-death designation, or TOD. It works on the same basic idea as a POD, a direct transfer that skips probate, but you file it with your brokerage firm instead of your bank. If you're holding stocks, bonds, or mutual funds in a brokerage account and there's no TOD on file, that account gets tangled up in probate just like any bank account with no beneficiary named. Retirement accounts, IRAs, 401ks, 403bs, already work on a similar transfer-on-death basis under federal law by default. But here's the catch. Most people filled out that beneficiary form the day they opened the account decades ago and never looked at it again. An old, outdated name on a retirement account causes the exact same problem as leaving it blank, sometimes worse. Under federal law, whoever's named as beneficiary on a retirement account wins, no matter what your will says or what your divorce agreement says. If your ex-spouse is still listed on an IRA you opened back in 1995, they could legally walk away with the whole balance, regardless of your will, regardless of your divorce paperwork. No matter how many years have gone by, go check those forms today. There's one more thing worth mentioning, the safe deposit box. A lot of seniors keep their will, deeds, and valuables locked inside one, then hand a spare key to a family member. That key means nothing once you're gone. Federal rules require banks to seal a safe deposit box the moment they're told the owner has died, and your family gets turned away at the door even holding the key. And if your actual will happens to be sitting inside that box, your family runs into a nasty catch-22. They need the will to start probate, but they need a probate order to legally open the box. The fix here costs nothing either. Just add your child as a joint renter on the safe deposit box agreement at your branch. Once you both sign, they keep access no matter what happens to you. So here's what to do before you click away from this video. Step 1. This week, either walk into your bank or log into your online account and ask for the payable-on-death beneficiary form. Every FDIC-insured bank has to provide one. If the teller looks confused, ask to speak with the branch manager. Step 2. List your primary beneficiary using their full legal name, birth date, and social security number. Skip nicknames and vague phrases like, "my kids." The social security number is how the bank confirms identity when it's time to pay out. Without it, things can get delayed. Step 3. Name a backup or contingent beneficiary too. If your first choice passes away before you and there's no backup listed, the account falls right back into your estate and probate starts all over again. Step 4. Turn the form in at the branch and ask for written proof that it's on file. Hang on to that confirmation with your other important papers. Step 5. Check every single account separately. Your checking, your savings, and each individual CD all need their own form filled out. One form does not cover everything. Step 6. Reach out to your brokerage and file a transfer-on-death form for any investment accounts outside of retirement plans. Step 7. Look over the beneficiaries listed on your retirement accounts and fix any outdated names right away through your plan administrator. Step 8. Revisit every one of these designations roughly every 3 years or anytime something major happens. A death, a marriage, a divorce, a new grandchild. Tonight, right now, your family still can't touch a single dollar in your account. That's the reality, unless you go fill out this form. The probate system isn't broken. It's doing exactly what it was built to do, straight from the Uniform Probate Code. The POD form is the one tool that runs on that same legal track and comes out on top. Go to your bank this week and ask for the POD form. It's free. It takes 10 minutes. And if this was helpful, go ahead and subscribe.